inflation's here. We all see it. Price of gasoline, eggs, milk, butter, groceries at the store, rents, electricity, home heating, fuel, you name it, across the board. Inflation's affecting everything. And it started really in mid 2021. So here we are, almost 2023. So it's been going on for well over a year. For the first 6 or 7 months, Jay Powell and, for that matter, Janet Yellen were like, yeah, we see it, but it's transitory. We know that story. Finally, in November 2021, Jay Powell threw in the towel, said, okay, time to retire the word transitory. Now let's get to work. And they started raising interest rates in March 2022. And we're now up to Fed funds rate of 4%. They're going to raise them again in December 14th by another 50 basis points. We kind of, still a little bit away from that, but we know it's coming. The Fed, this is the no drama Fed. They tell you what they're doing in advance. So I always say you don't need a crystal ball to figure out the Fed. You just need to listen to what they're saying and believe them. So they're going to do 50 basis points in December. That'll get the policy rate of the Fed funds target rate to 4.5%. But that's from zero. March 1st, it was zero. So to go from 0 to 4.5 in less than 9 months, about 8.5 months, that's amazing. We haven't seen anything like that since Paul Volcker in the early 80s. Now, I know rates are not 13, 14%, but to go from 0 to 4.5, I can say in 8 months is a shock. Now, why is the Fed doing this? Well, they say they want to kill inflation. Okay. But there are two sources of inflation. Inflation can come from the supply side, what's called cost push inflation. Costs go up and they get pushed into retail prices and consumer prices, and that is what's happening. That's because of the supply chain breakdown, energy prices, shortages of goods, et cetera. So that's cost push inflation from the supply side. There's another kind of inflation that comes from the demand side. And this is much more psychological. It's when consumers say, they just have it in their heads, and maybe from objective data, that prices are going up. And so they change their behavior. They say, I was thinking of getting a new washing machine, but I was going to wait 6 months, but I better buy it now because the price is going to be a lot higher in 6 months. Or a car, suit of clothes, a dress, furniture, whatever it is, better buy it now because the price is going to go up. That demand side inflation is called demand pull. You're basically pulling demand forward because of in anticipation of much higher prices. And there's a huge difference between the two. First of all, one can feed into the other. This is what happened in the 70s. The inflation in the 70s started from the supply side in 1974 with the Arab oil embargo as a result of the Arab-Israeli war, et cetera. It then fed in to prices, but then there were monetary blunders where the Fed printed too much money under Arthur Burns and G. William Miller, two of the worst Fed chairs in history. And then that changed the psychology. And then it came from the demand side. And that's when, gold went from $35 an ounce to $800 an ounce, 2,100% increase. And, but it affected everything. I mean, I was starting my career at that time, and I worked at Citibank, and they, as International Tax Council, they used to just give us raises. We didn't even have to ask. They would just say, hey, here's another $30,000 or whatever, because they were afraid people were going to quit their jobs, and they did. So they would just give you a raise without even asking. That's how crazy it was. Now, so where are we today? Well, we're definitely getting the inflation from the supply side, and that's clear. But so far, it has not tipped into demand pull inflation. Consumer psychology has not changed. We're paying higher prices, but a lot of this is because demand is inelastic, meaning you got to pay the higher price no matter what. If you have to fill up your Ford F-150 pickup truck because you got to get to work or do your job or take the kids to school, whatever, and it used to be $75 and now it's $150 twice a week, you still have to do it. It kind of doesn't matter because you need the gas and you need the truck. Now, where it does impact the economy is if you do that, it's $75 that you don't have for something else. In other words, you're like, okay, I just paid a lot more to fill up my truck with gas or my SUV or whatever, but now I'm going to, not go out to dinner, not go to a concert, not go to a sporting event, not buy a new suit of clothes, et cetera, because I can't afford it because I put all my money in the gas tank. And the Fed can't do anything about that directly. The Fed does not drill for oil. The Fed does not plant wheat or corn. They do not provide fertilizer. They do not drive trucks. They do not refine diesel fuel. In other words, when you look at all the bottlenecks that we've talked about, the Fed doesn't do any of those things. So they can't affect the supply side of the equation. All they can do is destroy demand by raising interest rates, which they're doing. We saw mortgage rates go up and housing prices come down, and a lot else. Prices are actually starting to come down. We'll talk about that in a minute. But my point being, if the inflation is coming from the demand side and you do some demand destruction, okay, that works, although it can be extreme as it was with Paul Volcker. But if the inflation is coming from the supply side, think about how much demand do you have to destroy to affect the supply side. It's not coming from the demand side, it's coming from the supply side. The answer is a lot. You have to create a severe recession and much higher unemployment to control supply inflation from the demand side. And Jay Powell has said this 4 times. He gave a speech in Jackson Hole on August 26th, a speech at a press conference on September 21st, another speech at a Fed press conference on November 2nd, and he just gave a speech at the Brookings Institution on November 30th. Now they're in the blackout period before the December 14th FOMC meeting. But it's 4 times. And he said the same thing all 4 times. He said, destroying inflation is job one. We know there's going to be a recession. He didn't use the word recession, but he as much as said that we know unemployment's going to go up. We know this is going to cause pain. He actually used the word pain 3 times in one paragraph. I've never heard a Fed chair use the word pain before. Powell has done that. He's been being very blunt about this. So they're out to destroy inflation. But here's what the markets don't see. Here's what the Fed definitely does not see, and what very few analysts see. Supply side inflation can feed to the demand side. Demand side inflation can feed on itself. But supply side inflation alone does not feed on itself. It tends to destroy itself. There's an old saying, the cure for high oil prices is high oil prices. In other words, if you make them high enough, and going back to what I just said about putting gas in your tank, think of all the things you're not spending money on. And that causes business failures, layoffs, higher unemployment, lower velocity of money. You stay home, like you said, you don't go out basically. And that's what's happening now. So we're starting to see inflation come down. When it comes down a little bit from 8.2% to 7.7%, people go, oh, it's still high. Well, it is still high, but that's a noticeable drop, and we've seen that a couple of months in a row. What's going to happen faster than markets and investors expect is that this inflation is going to come down so fast, it's going to be a strong form of disinflation. Now, disinflation is still inflation, but it's lower inflation. And in terms of response functions, it bears a closer resemblance to deflation than it does to inflation, even though it's still a form of inflation. When when inflation is coming down, what else is going on? Well, real interest rates are going up, and the economy is slowing down. And then it could even tip into deflation. That would be a shock to the system. I mean, in that world, cash is your best performing asset because the real value of cash actually goes up in deflation when everything else is crashing around you. So yeah, we're in inflation right now. It's painful, but it's starting to fade more quickly than people expect. And my forecast, based on a lot of analysis, and it's all in the book, Sold Out, is that this disinflation, borderline deflation will prevail. And by really just in a few months, January, February, March 2023, if not sooner, we're going to be in a very severe recession. And people are going to be surprised at how quickly inflation comes down, and they won't be positioned for it in terms of their portfolios. I mean, for example, a 10-year Treasury note would be a very good performing asset in this world, because yield to maturity on 10-year Treasury notes has been recently 4%, and now it's around 3.5%. That could come down to 2.5% in a heartbeat, even lower, and that would produce huge capital gains. So it's a big deal for investors and asset allocation and portfolio management, and a lot of people don't see the disinflation coming.